Hello friends, in this video, I will explain what you as an investor should look at before buying value stocks for your portfolio. We have curated a list of 6 value stocks in our model portfolio so beginner investors can refer to this list and invest. Now this list is for a longer term horizon, keeping several fundamental factors in mind. As an investor, this video will guide you to make your own checklist and research these stocks better. Firstly, a brief on value stocks. Now, Benjamin Graham coined the term value investing and is known as the father of value investing. His book, The Intelligent Investor, very well sums up the crux of value investing. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Warren Buffett, protege of Benjamin Graham, embraced and mastered the value investing approach and went on to become the richest and the most admired investor ever. Now, picking up value stocks works on the process of finding out stocks that are currently undervalued, buying them at a much lower price, and staying with them until they gain and provide excellent returns. In simple terms, value investing is an investment approach that seeks to profit from identifying undervalued stocks. Now, it is based on the idea that each stock has its own intrinsic value, that is, what is its true worth. Through fundamental analysis of a company, an investor can determine what this intrinsic value is. Now, the sole idea is to purchase stocks that trade at a significant discount to their intrinsic value. So that is, they are cheaper than their true value, which would give an investor a margin of safety. It is of utmost importance for an investor to analyze and understand the company to be invested in before buying any value stock. A few characteristics which would be kept under one's radar while investing in these value companies are the company's runway, that is, its long-term plans, its business principles, financial stability with healthy capital structure, along with identification of management's efficacy running the organization. Value investors should also place a great deal of importance on companies that pay consistent dividends. Some useful valuation techniques are used to compare stocks from the same industry and analyze if it's over or undervalued company. Relative valuation multiples such as price to earnings, price to book, EV upon EBITDA are famously used. Now, another well-known valuation method is discounted cash flow. Now, this valuation style uses a number of parameters, right from free cash flow of the company to the cost of capital to reach the final true value, which is compared to the current market price of the stock to judge if a company is fairly valued. Certain investors also look at PEG ratio instead of PE, which compares PE to the growth of the company. But not all multiples will give you the same value, and certain investors use the blended valuation technique. It is the weighted average of various intrinsic values by different methodologies. It is important for an investor to see which valuation technique is best applied depending on company's business model. For instance, capital-intensive companies is best to use the EV upon EBITDA multiple. Now let's look at a few factors in detail. Firstly, the top line and bottom line. Now, top line refers to company's revenue, while the bottom line is its profit after tax. Now, it is important to pay attention to them for any signs of changes from quarter to quarter and year on year. Any significant decline should be a red flag which would need a deeper look. Consistent growth is what an investor should look for. For instance, Mphasis, which is a mid-sized IT company, has a top-line CAGR of 8.82% and bottom-line CAGR of 12.58% in the past 5 years, which is considered decent by value investing standards. Next is operating profit margin, which is also known as operating income margin, is a measure of how much profit a company makes after deducting its variable costs of production. A company needs to keep a healthy margin in order to pay its fixed obligation such as interest on debt and taxes. A high and improving operating margin is an excellent indicator that a company is being managed well and has some sort of durable competitive advantage which can help protect its market share and profitability over time. Now, Pidilite Industry, which has Fevicol as its mother brand, has operated with consistent operating margin over the past 5 years and currently stands at 19%. Now, moving on to return ratios such as ROE and ROCE. Now, both these ratios are used to measure efficiency with which a company can generate profits. Now, these ratios are of utmost importance, which should be compared with industry peers to pick the best bets. The trend of this ratio should be looked at to see if they are improving or not. Now, you can see that companies in our model portfolio have clocked a healthy return ratios. Now, from the balance sheet, you can check company's debt to equity ratio. It helps to determine how company finances its assets. Now, too much debt can pose a risk to the company since the cash flows will be used to meet the debt obligation instead of reinvesting in the company itself. If a company has high debt, it can cause the market to value it more cheaply than companies with relatively low debt. However, debt that is too high can be a cause for concern. So it makes sense to incorporate this matrix in our analysis, and the debt to equity ratio is one of the most effective and also one of the easiest to calculate. It is seen that all stocks in our model portfolio have no or low debt levels. Now, coming on to valuations, EV upon EBITDA is a popular valuation matrix to compare the value of the company to its industry peers. The comparison of relative value among companies within the same industry is the best way for investors to determine if the price they are paying for a stock is more than its fair value or lower. This multiple can also help in understanding if a stock is overpriced, fairly priced, or underpriced relative to the company's true money-making potential in the same industry. Now, the sole idea is to purchase stocks that trade at a significant discount to their intrinsic value, which would ensure margin of safety, and hence the investment is to be made in undervalued stocks only. Let us take a look at our model portfolio. Now, you can see that Pidilite Industries seems overpriced when compared to its industry average of 27 to 28 EV upon EBITDA, whereas Gujarat State Petronet Limited, which is GSPL, has the lowest EV upon EBITDA within its sector. Now, next is dividend yield. As explained, a value investor places a great deal of importance on companies that pay consistent dividends. Value stocks are known for consistent and increasing dividends. Now, the dividends are the portion of company's profit that are distributed to the shareholders. It is important for an investor to find out if any company is consistent and is increasing dividends over a period of time. Now, take a look at our model portfolio. Each company distributes a good amount of profit as dividends. Now, Sonata Software has the highest dividend yield of 7.09% when compared to other players in our model portfolio. Coronavirus crisis has destroyed economies and wiped out years of saving. During such a challenging environment, markets are likely to reward companies in the long run that are generating high free cash flows and thus can service their debt and other fixed obligation through cash accruals and reinvestments. And hence investors should focus on such stocks for their portfolio as value buys. Now, make sure that value buys don't become value traps and the growth is consistent, or else an investor should exit immediately. Now, for most part, investment in value stocks is associated with long established companies that have steady but not rapid growth rates, comparatively stable revenues, and consistent profitability. So the idea behind investing in value stocks is generally not to make you rich overnight, and that is not the goal. If you have heard the expression slow and steady wins the race, is one of the best way to summarize the strategy behind value investing. Thank you.